The world has changed. Future without boundaries is just around the corner. The way we live today can become obsolete tomorrow. A whole new dimension driven by the evolution of AI and virtual reality. Are you ready for the inevitable?
From meme to utility, Floki has it all. NFT metaverse game called Valhalla. Floki University, DeFi, charity, and shopping. Floki is governed by the people, for the people. Floki, together, there is no stopping us.
Hey everybody, this is Adrian Zlinchik, CMT Charter Market Technician. Some people know me as CryptoBurb, and this has been a partnership highlight to our excellent partners, and the credit goes where it's due, since we are partner up publicly with excellent brands such as Floki and Unbound, and this is a huge shout out to them, and thanks for sponsoring us along with this video. And everybody, this is Friday webinar. Friday is this is the first Friday of the year. This is the first webinar of the year. There are many first things on the year, man, and this is incredible because we're gonna have such an excellent year this year. We're gonna have such an excellent opportunity for growth. We're gonna have so many incredible rallies ahead. And listen, I make mistakes every day, 5,000 times since I just woke up early today. You know, I'm wrong about my trades. I'm wrong about the predictions. It keeps people, it keeps us humble and down to earth, because you cannot fake the market and you cannot try to game the market. The market is always going to humble you, right? So it's best not to approach the markets with any sort of like prejudice, and any opinion, any attempt to prove something to the markets is very often discounted and proven wrong. So now I'm here today to kind of like buzz around the very hot topic, which is the Bitcoin ETF, right? Because there's a lot of news coming up. There's a lot of news pieces coming up, and that speaks of Bitcoin ETF. And there are many narratives. There are many points where some people are going to tell you it's going to dump, the others are going to tell you it's going to pump. In reality, no one knows. No one knows unless you pull the strings, and also unless you do illegal insider trading and you propose the law regulations and do set up your trades beforehand on illegal access to information. You don't know what the future brings, right? And if you watched that's my favorite movie, The Wolf of Wall Street by Martin Scorsese with Leo DiCaprio. You know, they mentioned one thing. The Martin McConaughey mentioned one thing. You know, that no one knows where the market goes. No one knows. It can go up and down, backwards. You know, back in time. No one knows that, right? That's a reality. Now, of course, there's a lot of shitstorm right now happening around those big names, including the politicians and so on. So I'm not gonna make any political claims. However, what matters from the market perspective is that there's a lot of volatility these days. That the anticipation around Bitcoin ETF causes a lot of uncertainty. This uncertainty causes a lot of volatility, and this volatility causes a lot of risk, because guess what? In finance, volatility is a measure of risk. Okay, and measured differently for the fundamental traditional analysts, the risk is going to be measured as the annualized volatility, for instance, right? However, most of the time, we, the technicians, the charter market technicians, we are gonna basically come up and say that the volatility is measured by the techniques, right? By the technical analysis in those terms, by ATR, average true range, for instance, right? Which basically measures the volatility and the spread of the prices between the lows and the highs within a given period. Yeah, let me know how you guys are doing. Where are you coming from? What's the temperature up like? Where you are, how you're feeling, if you got your coffee, if you got your tea ready, because we're gonna dive in. And like I said, check the markets, check how Bitcoin coincides with the other markets, because it doesn't trade in vacuum. And in order to do it, in order to put it in a little bit of a broader context, we do need to account for the other markets, which is exactly what we're gonna do. However, first, let me know, guys, how you're feeling. I'm pretty excited pretty excited. As you can tell, there's a lot of smile. There's a lot of great, excellent challenge and opportunity that we're all going to face in this year. This is a year of opportunities. Last year was the year of recovery. This is a year of going past and beyond the recovery. This is a year of persisting, most likely to the upside, right? And like I said, while no one knows the future, our job as traders is to detect the trends for the profitability. That's the choice that you have to make, that we have to all make, whether we want to be right often or we want to make money. There is even an excellent book written on that very specific topic, being right or making money. Those are two different things. And you can either be right a lot, quite often, and don't earn a lot of money because you take high probability trades, which by definition, they're not going to be, many of those, however, they're not going to be profitable, right? However, and then there's the profitability, right? So you can either be right a lot or you can make money a lot. However, those bigger runners are infrequent. So either you make a lot of small money often, or you make a lot of big money not so often. And I'm the other guy. I'm the second latter guy, right? So I follow the trends. I'm a trend follower. I follow the trends. I trade trend breakouts, and we're gonna basically discuss the markets from this perspective as we go today. So it's Singapore, 2 a.m. There you go. Wow, that's a spirit. Congratulations to you, Funny logo, by the way. Congratulations to you on your spirit. Excellent attitude. Love it. Very well done. Brian Barnes, Michigan, USA. Ready for the new year. I'm with you, Brian. That's awesome. And greetings. Is that going to be Ireland? Very cold here today. Trader Moonjo. That's so awesome. Sorry, I cannot see the proper emoji out of the flag. I don't know if that's the colors displayed. If you could confirm if that's an island or that's another country, I'd just so much appreciate it. Like I said, I'm a little bit limited on the visibility here. And happy New York to everybody. Happy New Year to everybody from New York City. Happy New York, you could say, to everybody. That's awesome. That's awesome. And like I said, I've got a whole proper review for you guys. So we're gonna check and get a quick glimpse into what's happening in the markets to get a proper taste. Okay. And well, without further ado, Ireland. There you go. Right on. And without further ado, let's check in the markets, please. Okay. So first of all, Santa Claus rally failed, right? The last 5 trading days of 2023 and the 2 first trading days of January basically pointed to the downside. And as Jeff Hirsch, as my good friend Jeff Hirsch mentions, there's this January trifecta, that overall constitutes the positivity, the seasonal aspects of January, right? There is a January barometer with 83.6% or 84.6%. Sorry if I don't remember correctly. I might want to check out those numbers over many, many decades. That confirmation that the probability of checking out that as January goes, so goes the whole entire year. If January closes positive, the year closes higher than it opens. If January goes negative, just like it did in 2022, 2018 for the bear markets, that typically suggests and implies the slowdown, that the market is not so much excited opening up to the new year. If the excitement especially comes after a heavy series of inclines, well, this may be a little bit of corrective mode, right? Because at the end of the day, we closed 2023 with very significant increases, 25%, 50% for NASDAQ, right? Or so. So very significant rises. And especially in the later part, which checked out ideally in line with the expectations of the seasonal patterns, such as strong Q4 close. Look at this incredible push from November, 32,500s all the way to the new all-time highs through over 37,500s, right? As we broke to the new year. So that overall coincides, like I said, with a lot of growth, very positive movement. All the averages are up if you take a look, right? And that tells you that the trend is up. However, in the bull markets in a very strong thrust, it is still possible to see corrections, secondary tides, secondary movements, right? So who knows where that goes? Perhaps we're going to retrace somehow basically to the previous peak area which coincides and aligns with the 50-day trend average. That would somehow translate to medium-term correction into typically slower, weaker January and February. Okay, February is the weak link in the best 6 and best 8-month strategy that Jeff Hirsch often refers to. that start off from October, November, and last until May, June, purport accordingly, right? So who knows? Maybe January, February are going to be months of correction, right? Maybe because of strong correlation of Bitcoin to the traditional stock market, it's going to translate into weaker Bitcoin as well, right? And corrective Bitcoin, especially after heavy rises. We're going to see about that. No one knows the future. However, like I said, in order to know the impact of the Bitcoin ETF, it's okay and it's fair to check out other markets as well. Okay, so well, very strong push since November, perhaps some due correction. If I see any reason for the market to pull back, to throw back, that might be into 35,500, 36,000. We love those round numbers. We love the round number magic, this magical thinking that is often self-fulfilling, right? Because we love round numbers. They're easy to remember. We are naturally going to anchor to 36,000, 36,500 rather than 36,732, for instance, right? Because it's different. It's difficult to memorize. And if it's difficult to memorize, not so many people are going to be able to play along with it, right? Plus, the round numbers have special ease in our minds overall, which is why we tend to anchor to them. S&P 500 local weakness right there. Okay, some local consolidation, some broadening pattern, if you will, broadening triangle, if I were to guess. However, what matters is that it's literally balancing right there, the thin 20-day support, 20-day moving average support that often acts as a support. And again, 47 hundreds, right? Also very close to the new all-time highs overall. We didn't manage to break through and persist. However, we almost got the touch point, and potentially we may be falling into 4600s area. Who knows? What matters is that the 200-day moving average is up and it's accelerating. It's moving faster, which means that the dominant market trajectory, the dominant market tendency is moving up. This is a bull market, ladies and gentlemen. Regardless of what happens here, it cannot erase and evaporate the whole bullishness out of the market, because that's the main narrative. And the bull market, bear market trends are like those speeding trucks. It's impossible to stop the speeding track with your body weight. So, which is why we want to follow the trends, right? Trying to counter trade such powerful trends and be against the bull markets and prove the market wrong, that you are right and not the market is right. It's a suicidal idea for your money, right? It's not necessarily the smartest, wisest choice, because most of the time the trends persist, and they do so until this significant market factor is taken away, and until you stop pressing on the gas pedal in your car, right? It's going to continue to move faster and faster. It's going to continue to accelerate, and as you know, the market technicians kind of like try to anticipate it in market changes, and by observing the quantified behavior, right? Technical analysis is nothing else but a toolkit to manage the risk based on different techniques. Some of them include the moving averages. Hope you can see me and hear me all right. Before we jump in, let me know real quick if you guys have any specific questions as we go, because I'll do my best to cover some of those through all my ramble. And I'll do my best, like I said, to take one or two chart requests. So if you have any tickets you want me to check out, I'll do my best to check it out real quick. And let's move on. Move on. So the consumer discretionary is a little bit down. Energy is chopping around, barely kind of like hovering around the 200-day moving average, which is slowed down significantly. Okay. Well, what are we looking at? The airlines local rebound, local correction after very significant decline over 2022 overall. The 30-year treasuries, the bond prices are retracing just a little bit after the powerful breakout, the bull market breakout out of the 200-day moving average. They're pulling back just a little bit. There's a positive 20-day over 200-day, 20-day over 200-day moving average crossover, which is a good thing. The short-term and the medium-term averages are exceeding the 200-day average pace and direction, right? Which tells you that this is likely a positive reversal, as the long-term investors acting upon the long maturity of the yield curve are basically anticipating, easy monetary policy or easing monetary policy this year towards the U.S. elections in November 5th, if I'm not mistaken. You may want to check everything that I say. Like I say, I always may be wrong. the yields are up a little bit, right? Corresponding the over 40 points, 40 basis points there for TNX for the 10-year yields. For the 2 years, we're talking 438, which is slightly higher. For the 2 months, well, 3 months, let's take a look. 3 months are still 548, which tells me again that overall the yield curve is still inverted, which is if you go to the other chart, which is something that is actually confirmed, right? Because at the end of the day, if we take out 50 years out of the data, well, we are still talking about heavily inverted yield curve, right? Because the 10 years minus 2 years basically tells you, well, if you lock in your money with government, with treasuries for 10 years, the yield should be bigger because you lock in your money for longer, right? So there's a bigger risk for uncertainty, and that should be compensated by the risk premium with the percentage of the higher yield, right? However, if the situation is inverted, if the government, if the Fed regulating body is over tightened, well, this translates into inverted yield curve, right? This tells you that the market anticipates lower rates than there actually are dominated and induced by the Fed, right? This means the Fed has over tightened. And if they have over tightened, well, that doesn't necessarily, that suffocates the economy just a little bit, right? And even though there might be a little bit of soft landing, it seems this way, right? However, what I would say is that we have to be extremely cautious, right? Because the inverted yield curve typically is a leading sign, the interest rate is a leading sign of recessions. And most of the time, if not every single time that we had deep, severe depressions, and that one that we just experienced was the deepest since the 80s. So in over 40 years, that translates to the recessions. Recession means economic contraction, right? Because at the end of the day, the markets, if we go to the performance chart, the markets move in cycles, and the market cycles lead, the financial market cycles leads the economic cycle, which is the business cycle, the orange one, by 6 to 9 months. Okay, 6 to 9 months on average is the lead time where when the market moves up, we typically have about 6 to 9 months before the economy starts reacting. And it's fairly easy to understand because, well, guess what? If everybody makes money on the market, well, everybody is happier. They are more confident. They are more optimistic. And if they are more optimistic, they can spend more money on goods and services. And if that happens, guess what? The economy starts inclining and improving, right? Because it gets an injection of money. Right. So at the end of the day, 2022 was a down year for the markets, which 6 to 9 months later brought the economic slowdown, right? And regardless if it's a proper recession or not, eventually that's something that we don't know. The Fed doesn't know. What we know is that the Fed seems to have over tightened by the market standards. The market prices in lower rates in the longer end of the maturity curve, of the yield curve, than the Fed proposed, right? And well, XLY versus XLP, which is a risk on risk off ratio, tells us that an overall trend, the dominant tendency has been rising. The dominant tendency is basically the 200-day moving average of relative trend strength. And this relative trend strength continues to move up on average ever since 2023 basically came into play. So 2023 was a risk rotation change. The risks have rotated, the risk appetite has rotated for 10 to 2022. For the entirety of 2022, the market priced in more defensive stocks better and priced them more valuable over the risk offensive stocks, right? And the situation has turned. We got some significant breakouts, the series of higher highs and higher lows, which continues to persist and improve. And even though there's a little bit of a breakdown, like I said, and a little bit of a slowdown, the overall market tendency is inclining. The overall domination by the risk offensive investors, by the offensive risk aggressive stocks, risk seeking traders over the risk defensive traders, risk averse, tells us that there is a risk rotation to the upside. And this risk rotation tells you that the investors are more likely and more optimistic about taking the risks, which means more money in the markets, which means more liquidity, and the market's going up. Long story short, that's what it is. Okay. Let's take a little bit of a helicopter view since the year started. since the year started, what we're gonna see. January 2nd. Well, where are we? Well, it's just been three trading days. It's the fourth trading day pending, right? So it's not gonna give you too much details. However, the leading one is the healthcare, right? Right after, which is slightly 0.2% positive. The stocks didn't react positively overall to the beginning of the year with the failed Santa Claus. Utilities are the second, and the energy is the third. While on the far end is the consumer discretionary, and right there there's technology, and the orange one is the technology, and well, there's a Bitcoin, right? So overall, it seems that there is a slight local market rotation towards the defensive stocks, right? Defensive stocks. So there is a little bit of a risk rotation short term, which is something that is displayed over the XLY versus XRP relative strength ratio, confirming that locally, there is the market is in a phase of distribution, right? So corrective tides are the dominant tendency right now locally, right? Local timeframes. However, they do not interfere and they do not change, evaporate, or erase what happened over 2023 as a year of recovery and very powerful gains. So the way you may consider that is that it's just a temporary tide within an overall bull market, right? So January, especially in the election years, after powerful pre-elections, which gave a lot of profits, tends to be a little bit of distributive, right? Especially after failed Santa Claus rally, which is 2 out of 3 hit for the January trifecta that Jeff Hirschhofen refers to, my good friend. So we're gonna see there might be a little bit of corrective January ahead. February is also a weak link in overall in the best 6, best 8 month strategy, like I said, that Jeff discovered and propagated alongside his father. Although what matters is that the overall tendency is positive, that the overall trends are up. It's just a secondary correction, just a local tide to the downside. Let's take a look on how that all correlates with Bitcoin. Okay. 2 charts real quick. Right. While discussing the impact of the Bitcoin ETF, well, see, the point is that it's just a temporary thing. It's a local news event trading day, the release of the news that everybody anticipates, like the FOMC, like some important announcement from a company, like earning reports, right? Not so much accounted to Bitcoin, like Bitcoin ETF approval, like whatever other rumors are there. There's this learned behavior that we at times do, no matter why we think, no matter if it works. It's just the way we learned it. Those heuristics, those learned behaviors, are the things like buy support, sell resistance, which everybody thinks that it's the best thing to do in the world, while actually buying high, buying the confirmed breakouts and selling higher into the rising trend is so much more profitable than buying low and selling high. So you want to buy high and sell higher because this is a confirmed trend. And the confirmed trend is exactly reached by those behavioral techniques, by behavioral finance principles that basically push the market into the extremes of the supply and demand, of the extreme greed and fear, because we are filled with biases, we are filled with prejudice. And as long as we are overconfident, we're going to overspend, we're going to overinvest, eventually leading to our own financial ruin and disaster. However, that's what the market does. It doesn't really search for a lot of rational. And for those who've got, the bird and the mustache, at times you guys know that it just literally is great, it itches your nose. So what I do is I follow the trends, okay? And all I know is that the trend is the journey. It shows you the direction. So you don't have to ask yourself what Bitcoin ETF is going to do, because from the long-term perspective, it's completely irrelevant, other than a more educated guess is that, hey, maybe if the regulations are here, fundamentally, it's going to open up the doors to trillions of dollars. So it's probably bullish more than bearish overall, right? However, it's fairly impossible to predict the exact behavior on the launch day, right? Because first of all, we don't know the future, so that makes it impossible to guess. And even if you guess right, just like you flip a coin, it's impossible to keep flipping the coin 100% right on all the time. If you guess that flip coin, the coin flip 10 times in a row, if it lands heads or tails 10 times in a row, it's luck, right? It's not that we are the best coin flippers in history, it's just luck. It's something that shouldn't have happened, yet it happened. It's something that goes against the theory, yet the market kind of like rewarded you. So what you do is you take the windfall profit and run, because guess what? Statistically, it's not likely to hold this way for a long time. So it's impossible to predict the short-term impact. Some people say it's going to dump. Some people, the others say it's going to pump. No one knows that. What we typically know is that people tend to anticipate certain news. So there's a lot of volatility rising into the news. If there is, let's say, a timeline and there is a point X on the timeline being that Bitcoin ETF approval, what it often does, it elevates the volatility. It elevates, and the volatility, as we technicians call this, is the spread between the highs and lows of a certain period of time, right? Rather than the annualized volatility measured as a standard deviation, annualized standard deviation. It encourages more volatility because the uncertainty grows. When we are uncertain, we tend to make more stupid mistakes. And it may happen that just around the ETF, if we get a date, there's a lot of anticipation, there's a lot of hype, there's a lot of enthusiasm, excitement, and that encourages traders to speculate. And in order to speculate, you need to get an asset, you need to buy this, right? So, which is what often encourages the buy the rumor, sell the news type of learned behavior that often makes people sell the news, in fact, forgetting that the overall long-term trend is up. And it's not my opinion, it's literally the chart telling you this. The 50-week average is at $30,000, almost. The 200-week average is almost at $30,000. They are crossing over, by the way, right? All the averages are rising. And it's not even just on the averages. Well, guess what? The market moves up, higher highs and higher lows, right? Wave number one, wave number two of a slowdown or whatever sideways, right? And wave number three, we're in the third wave, the most powerful often wave in the bull market, right? The first wave after the bear market, when the trend changes, it's often kind of like very much wobbly and stable. It is just a mere weak reversal, wobbly reversal, filled with denial, uncertainty, right, disbelief, and so on. The market typically kind of like retraces slightly, which is a wave number two. And then when there's another breakout and people realize, hey, listen, maybe it's not necessarily the rally that's going to fail. Maybe, hey, the market keeps going up and I'm not on board. They're going to buy in, which is why often the third wave is the one that is the strongest, the most extended one, the longest, the most complex one. And we are just in the third wave of the bull market, everybody. And by the Elliott wave practitioners, theories and the principles, the markets, the trends, the corrections are 3 waves, while the trends are 5 waves. While the third one is typically the longest one, right? Which is the one in the middle, to the upside or to the downside, which is why you typically don't want to hold on to the losing positions, because it continues to lose more and more over the time. Eventually, same as it does in the bull markets, in the opposite direction. So the trends are moving up, which is confirmation that, hey, this is a bull market. Well, if in case it wasn't obvious, let's say to some people when Bitcoin gains 200%, more than 200% since the bottom into the highs, in case that wasn't obvious, right? Then the very simple definition of the bull market, bear market is just take a look at a 200-day moving average. If it falls, it's a bear market. If it moves up, it's a bull market, right? There's nothing to argue. It's not my opinion. It's not what I think. It's the line deciding bull or bear that tells you, hey, listen, I am going up. This is the market telling you, hey, wake up, I am going up, right? So this is the bull market. There is not a slightest doubt about that, right? And while I don't know anything about the future, I know everything about the past, okay? Because, well, guess what? What happened is irrefutable. We cannot deny something that happened, right? People that deny something that happened are delusional. They are denying the reality. And by denying the reality, guess what? You lose money. So you cannot pretend it's a bear market while the market moves up. It's just irrational. It tells you immediately that those who try to prove the market wrong, those who continue to say it's a bear market, they are either short to prove the narrative against everything, all the facts, or they're out of position, or they are short, they're out of position, or they just basically make fun of you. No other explanation. So all that is said, like I said, that the dominant tendencies is what drives the market. It's irrefutable that we're in the bull. And it's irrefutable because of the behavioral reasons, like I said, especially in the third wave of the bull market, that is the one that is the most volatile and so on, in terms of that, well, the trend volatility, right? It accelerates more and more as we go, as people realize, hey, listen, I missed out on 200% gains. Maybe I should get on board, right? Which encourages even more rise and increase. So it's just a matter of time, most likely, until we get past the all-time highs. And guess what? From the historical perspective, the halving, well, which is coming in April this year, in April this year, let's say Binance countdown, right? Binance countdown. The Binance countdown basically recommends that it's 103 days right now in terms of every 210,000 blocks that the halving occurs since the May 2020, which runs up to approximately 4 years. 103 days from now, what's it going to be? It's going to be 17th of April. So 17th of April is exactly what we're looking at in terms of the anticipation of the next halving. And even though we don't know the future, what we know for sure, because that's something that already happened, is that after every halving in 2012, in 2016, in 2020, and 2024, will you notice that all of those were election years, right? All of those are election years, 2012, 2016, 2020, 2024, right? So all of those align with the election years. All those often come with the monetary policy kind of like easing quite often. And what matters even more is that after every single halving, Bitcoin always rallied extremely hard. We're talking 90x, we're talking 30x to the subsequent peak, we're talking 700% to the subsequent peak. And well, I don't know the future. However, the pattern has merged that Bitcoin always rallies hard after halving. And guess what? It never comes back to the same halving prices. It never came back to the same halving prices, ladies and gentlemen, right? That tells you that everybody who bought into halving are profitable, right? It's a winning strategy until now. And even though it doesn't really have too many touch points and too many data points basically on the agenda, it still tells you just a little bit that, hey, maybe it's not a good deal to trade against that. So I told you that the volatility is up, and I really meant it, okay? So just to give you a little bit of better understanding, the volatility is, like I said, the ATR. Right now, the ATR is basically at 1700. It's the highest it's been in quite a long time. The volatility is the highest since it was in the market, when the market accelerated to the downside in, what was it, June 2022, right after the Terra Luna collapse, right? It was. So the market volatility is rising. And when it is rising, well, it tells you that there is risk rising. So typically you want to manage the risk in your portfolio by allocating less money to more volatile positions and more money to less volatile positions to compensate for the risk factors there, right? Because at the end of the day, the risk adjusted returns is what matters, not just the profit side. It's also the risk side to it, right? So even though I don't know the future, what I'm seeing is that the risk has elevated, right? And the risk has elevated. The RSI, the 50-day momentum trend is basically on the fall. The 50-day volatility is on the rise. right? The 50-day volatility is rising. The volatility breaks out above the historical highs over the last year and a half or so. So, well, how many times do you get 15 or 18 months breakouts? Well, once every 18 months, right? So it is infrequent. It is quite a powerful signal telling you, hey, that the volatility is increasing. And if the volatility is increasing, that often acts in favor of the dominant trend, because it tells you that the market is getting more and more excited, more and more anticipating the further increase as the trend continues, right? So even though I don't know the future may chop around a little bit, as a trend follower, I don't really have, a lot of fun in the sideways because it gets me out on stop loss 50 times a day. However, like I said, I just play along with the main trade. I trade the breakouts, right? So when I get a trend breakout in the direction of a trend, because that's what means I'm a trend follower, I make money on the trend itself. I never oppose that. Otherwise, if we are to just investigate just a little bit deeper, obviously we're in some sort of like a trading range. You know, the market is not really. It offered a couple of fake breakouts. The highs are on the high. The highs are on the rise. The lows are on the rise. The highs are somehow, you know, can capture right here. There's a lot of fake breakouts. There's a lot of volatility, like we mentioned, is the highest volatility in a year and a half. It's quite substantial information. However, what matters most is, that after those choppy periods, overall, the direction is to the upside. So typically, we could anticipate that after choppy sideways, we tend to look at a lot of upside breakouts, right? So as a trend follower, like I said, as the market moves 70% of the time in sideways, which it does over here, basically, and over here, for instance, when the remaining 20-30% of the time it moves in very powerful moves to the upside or to the downside, to the upside in the bull markets and to the downside in the bear markets. So what we know is that after sideways, after choppy sideways, that knocks me out of trades several times. On this very latest trade, I got stopped, I think, 4 times overnight. There's such a big noise and such a big chop, right? Because when I position my stop loss based on this private customized strategy that I have, that by the way makes me a lot of money, right? Once in a while, I get stopped a lot on small losses. However, when I have the big wins, I rally along with the trend, and that's the one that takes me out, that puts me in 28,500s, and that's the one that took me out at 42,500s, right? So that's the one that basically makes $200,000 on a trade, $100,000 on a trade, $500,000 on 2 trades early this year, right? So I get a lot of small losses. However, when I win big, and those I hunt only for those big wins, right? And I get stopped when those big wins don't come. However, they're kept small. The losses are kept small. That's the job of a trend follower, to manage the risk, and I manage the risk according to the volatility, right? So as a matter of fact, like I said, even though I get stopped and chopped like crazy, just take a look, right? This is my typical stop loss right now, indicated by the strategy. There's one stop event, there's another stop event, right? That just happens ever since the trade got open. Then previously, the stop was trade here, and I got stopped here, I got stopped here, here, here. However, when it finally breaks out to the upside, it catches and it rallies along those 30-50%. Well, guess what? All those tiny losses get compensated by one big win, right? And the trend following is confirmed to be the most profitable strategy and system overall, right? So even though I don't know the future, I have no idea where the market goes. I'm wrong very often. 7 out of 10 trades, I'm wrong, and I lose money on those. However, because I adjust my stop loss and I adjust my position size, I manage my risk according to the volatility techniques, which is something that the fundamental investors do not have and can only dream of. I can quantify my risk, I can quantify my exposure, manage my risk accordingly. And if the stop loss is fatter, I put a smaller position. If the stop loss is closer, I put bigger position. All right. And that compensates for the risk. And that helps me manage the risk, because at the end of the day, statistically, the market is going to eventually jump up. And if it does, I'll win alongside in a big fashion. So just to give you a quick wrap, like I said, the overall sentiment has been positive, right? Look into Bitcoin, quite a nice platform. I'm not affiliated. 72 out of 100 fear and greed, which is telling me that the market overall is in the rising sentiment, that people are feeling much more excited overall about the market. The short term, just take a look at this volatility, right? It gives you a lot of fake signals, right? So what it does, small volatility looks like this, right? And it's just a tight range, basically, within those highs and lows. However, when there's anticipation of the Bitcoin ETF, which is basically what's happening over here, the market starts going crazy, and the same stop losses, the same range bound environment is getting more and more chopped because the market is getting like a boiling water, right? If you have a boiling water basically on an oven, and there's the fire basically boiling that, right? The water starts boiling, and the water starts boiling, the lid on top of it basically starts lifting. So that's the situation where the water is boiling, basically. The market is boiling, getting ready for a big move. It gives you those big choppy movements that are increased risk, right? They're increasing your risk. And when they're increasing your risk, it's unwise to invest and overinvest. So you typically want to adjust your position size to the risk that you take alongside the trend. So that's the situation. The market is boiling right now, right? The water is boiling, the market is boiling, the people are getting excited, uncertain. It's pushing into extremes. The volatility is very big, and that's all I know. Right. So even though I don't know the future, I know that the volatility is big. And even though I don't have to know the future, because there is no way of knowing the future, what I know is the volatility is bigger. If the volatility is bigger, I just need to adjust my risk accordingly. That's all that I know. And that's all that I have to know as a trader. Otherwise, there might have been, by the way, I put out a nice, decent, well, hopefully decent, you're going to enjoy that thread about 2024 expectations, something that is pinned on my Twitter. You can go ahead and double check on the check marks and so on, because there are so many impersonators and fake gurus and scammers just falling for that, trying to impersonate me and so on. So stay safe. What I mean is that there's a pinned tweet post with the thread for 2024 expectations, so and the market outlook. Feel free to check it out. However, what I mentioned is that there is an offer, FOMC. Let's take a look at the FOMC trading guide, because I posted a proper explanation about the FOMC, which basically translates to this increased volatility events such as the FOMC announcements, the Bitcoin ETF announcements, and so on and so forth. So as we enter, we typically have rising volatility. We have the biggest volatility around the event, during the event, and the volatility cools down, the risk cools down after the event, resuming the overall market direction, in this case upwards, right? So that's a typical kind of like a go-to solution. And what we know is that those impacts, those buy the rumor, sell the news types of events, well, are mostly of 8 features. It only comes with a short-term impact, so it doesn't interfere the long-term trend. It expects a price shock. Means if you make money on a coin flip, you better take the windfall profit and run, because it's not supposed to be maintained and held over the long term. FOMC and the overall Bitcoin ETF anticipation pates are noisy. Okay, noise means risk. It means non-technical. It means randomness, and it's elevated noise. So you don't want to overinvest in that time. Mostly coin flip, no statistical edge proven over the time. If you get a windfall profit, you might want to close it. Buy the rumor, sell the news is the main heuristic, basically, in behavior that transpires. Disparity means volatility. The bigger the disparity between the expectations and the actual reality, between the rumor and the news, the greater the volatility, the greater the risk, the greater the losses. Okay, so take that into consideration, and do not fight the Fed or dwell. Do not find the Fed. Find the overall tendency. The recommendation I give is that for an average risk-averse and loss-averse trader, it is suggested to stay on the sidelines. Okay, at times no action is the best action, and still making money. Decisions based on rational individual risk preference is necessary. Some people just love risk. They're gamblers by nature, and it's good for them, right? So take that into consideration and just refer to it as some sort of like educational piece, if you will. Of course, not financial advice and so on. So all that is to say that even if we get a lot of, by the way, this is our, we are partnered up with the Paul AI, great partners of ours, incredible thing. And on our Discord announcements, just real quick, consider that a promotional piece, whatever. It's an opportunity for you, guys, because we put together this a nice idea with PaulMind, with our partners at PaulMind, basically. And this is an exclusive offer to the Burb Nest members so that you can get an access to the Discord and get all the free membership, whatever. It's basically special gesture to the Burb Nest community, where our partners have offered to extend a 20% buy boost to anyone who purchases 5K or more of their PAL via Uniswap until January 6th, right? So it's until tomorrow that the 20% buy boost to anyone who purchases the PAL token is there, right? So following the purchase, how it works is your 20% boost will be deposited into a staking pool with a 56-day lockup. And after that, you'll be able to trade or restake your token. So you basically get a 20% boost to staked over the time, and you'll earn additional 10% passive income by just staking. Official contract address, that the link to that, and we're gonna be able to activate that and to the community members of the Burb Nest. So feel free to go ahead and check out on the announcements. I'm going to drop the link also in the description. You have all the free access and the free membership ideas in the YouTube description to this video as well. So if you're watching that and you don't forget to hit subscribe button, smash notification bells, and click on the description button, click on the description links to get you transferred to this offer that is exclusive, right? Shout out to our partners at PaulMind. However, what I wanted to say is mention is that overall, the news feed suggests that BlackRock 10 million Bitcoin purchase will happen today. Expert SEC says backed into a corner. There's so many news coming up, right? Bitcoin ETF approval is close to done. Bloomberg expert and so on. According to the sources very close to the subject, SEC will approve Bitcoin spot big day tomorrow. What doesn't even matter. What matters is that there's a lot of hype. There's a lot of volatility. There's a lot of rumors. And that doesn't change the trend. It just boils the market up. See what happens when you boil the water. The lid starts moving up, right? It's getting impatient. It's getting volatile. And this volatility means risk. It means risk of getting burned, means the risk of getting burned on your portfolio in the markets as well, right? So overall, you might want to basically follow the trend. You might want to not overinvest in that time, regardless of the outcome that no one knows. In the short term, it's a coin flip, statistically proven and confirmed. Then the long-term trend will re-emerge, because that's what it typically does. And we don't have to know the future. We just have to know the past well, and that's enough. That's all. That's all basically to be mentioned and to said about this, right? So the Bitcoin ETF will cause big volatility in the crypto market. That's what it is, and that's been the main narrative. And well, before we go, perhaps you might want to check out the new cool features that we have on theburbnest.com under the tools that you can basically check and navigate into the heat map, into the heat map that we have on the economic calendar, if you will, right? Alongside the important releases. It's loading just a little bit. However, you can tell about the unemployment rate, the core CPI, and so on. So it's all put together for you, and it's sourcing the data literally from in real time. So feel free to refer to it. We got a free newsletter, free infographics for everybody if you want to learn, right? You don't have to pay for anything if you want to learn. There are 50,000 content pieces every day of free education. However, if you don't want to subscribe, we have a free offer to those who want to get free premium signals for free. And if you want to get the signals for free, just go to the Burb Nest, go to the services and calls only, and you're going to be able to acquire for free. Just click on this button at the bottom, I want my signals free, and it takes you there. And that's it. You might want to check it out, theburbnest.com/calls only, theburbnest.com, go to the services, calls only, activate your free membership, and stay as long as you wish, right? And those calls are profitable, proven, tested, transparent, and it's been rolling since 2017, the 7th year of the Burb Nest is on. Guys, it's been my honor to have bored you to death for the past 40, 50 minutes or so. I'm your host, been your host for today, Adrian's CMT Charter Market Technician. Have a great time and have a great year. Happy New Year, everybody. We're going to crush this. God bless. Stay safe.